Every time history has recorded a devastating recession, every time the world's largest markets have collapsed, whether it was the crash of 1929, or the crisis of 2008, we look for a villain. We blame the stock market, poor government policy, or greedy bankers. But let me tell you, there was only one true power behind all these catastrophes. Debt is not just an economic term, it is the fuel that runs the economy, and it is the explosive device that can tear it apart. If you want to understand the true secrets of finance, you must understand debt. Today we will uncover what debt is, how it's created, and how it can silently sink an individual, a company, and the entire world. Let's start with the basics. What is debt? It is a very simple contract. One party, the debtor/borrower, receives a specific amount of money from another party, the creditor/lender, promising to return that amount, the principal, plus interest, within a set term. Debt is older than currency itself. In ancient Sumeria and Babylon, debt was recorded on clay tablets. Kings often had to issue clean slate decrees to wipe out agricultural debt and prevent civil unrest. This tells us one thing: the power struggle between creditor and debtor is eternal. The cost you pay for using someone else's money is interest. The faster your interest compounds, the more financially devastating the debt becomes. This is where the first secret lies. Debt gives you two things: purchasing power, which you didn't have right now, and an obligation, which becomes a permanent claim on your future earnings. As we know, not all debt is bad. We categorize debt into good, bad, and sometimes, a tricky gray area. 1. Good debt, debt that generates wealth or increases your earning potential. E.g., business expansion loan. 2. Bad debt, debt taken purely for consumption and financing items that decrease in value. E.g., credit card debt, financing a rapidly depreciating car. The gray area, what about a home mortgage? For most, it's the largest debt they will ever take. It builds equity, good debt, but it also ties you down and incurs massive interest over 30 years, bad debt element. The key is leverage. Are you using it to your advantage? We also have secured, backed by collateral, like your house, and unsecured, no collateral, like a personal loan. Always remember, the higher the risk for the lender, the higher the interest rate for you. This is the market's way of pricing risk. Now let's talk about the macro level. How do banks and governments use debt to run the entire economy? Secret number 2, banks create money through debt, the money multiplier. Keep the previous section on fractional reserve banking and the money multiplier as is, as it's crucial. This engine runs on credit, and that brings us to the debt cycle. Ray Dalio's economic machine. The legendary investor Ray Dalio popularized the concept that the economy is essentially a simple machine driven by transactions and credit. The short-term cycle, 5 to 8 years, driven by central banks raising and lowering interest rates. When rates are low, borrowing is cheap, the economy expands. When inflation hits, the central bank raises rates, debt servicing becomes expensive, and the economy contracts into a recession. The long-term cycle, 75 to 100 years. This is the dangerous one. Over decades, people and countries take on more debt than they can realistically repay. The level of debt becomes so high that simply lowering interest rates doesn't work anymore. This long-term peak leads to deleveraging, the painful period where everyone, governments, companies, people, has to pay down debt, destroying demand and leading to a depression. This happened in the 1930s, 1929 crash, and almost happened in 2008. Let's connect this back to history. Case study: Subprime Mortgage Crisis, 2008. The crisis wasn't caused by debt alone, it was caused by bad debt. Lenders gave mortgages to people with poor credit histories, subprime, assuming housing prices would never fall. They then packaged this bad debt into complex securities, CDOs, selling the illusion of low risk. When housing prices dropped, the underlying assets, the homes, were worth less than the debt, and the entire pyramid collapsed. Corporate debt bomb. Today, many corporations hold massive amounts of debt. If the economy slows, their revenues drop, making it impossible to service that debt. This leads to corporate bankruptcies, massive layoffs, and further economic decline. Understanding a company's debt-to-equity ratio is your secret number 3 to judging its financial health. Now that you have seen how debt works from ancient Sumeria to Wall Street, here are the final, actionable secrets for your own financial life. Secret 4, master the debt avalanche. To gain financial freedom faster, always prioritize paying off the debt with the highest interest rate first. This saves you the most money in the long run. Secret 5, always have liquidity, keep a cash emergency fund. The worst time to borrow money is when you desperately need it. Having liquid cash prevents you from taking on high-interest debt during a personal crisis. Final thought, debt is a weapon. It can be used by the smart to amplify their success, leverage, or it can be used against the ignorant to amplify their failure, interest. The choice is yours. Which do you find more dangerous, government debt or corporate debt? Let me know your thoughts in the comments below. If you want to uncover more deep secrets of finance and history, don't forget to subscribe.